Welcome everybody to the Thursday call. We have a good one for you today. We have Miss Alice Chen and James Livingston, and there's no relation between Alice and myself. We've already discussed that. But we're going to be talking about a topic that I feel like is an underlying conversation that happens among private conversations all throughout family. I can always walk by hearing people talk about it. And I always see people pulling Alice aside, asking her questions. So there's an obvious interest here. If you're here today, we're going to be talking about private equity. That's right, private equity funds and private equity trends. I'm going to go through some bullets. I'm not even going to pretend like I know this space or any of the information here. That's why we have the experts here. But we're talking about private equity fund structures, investment thesis construction, and selection of operating partners. That was a mouthful. Legal documents, compliance frameworks, understanding financial terms and pro formas, and fundraising process and frameworks. I know some of you are in the process of wanting to start a fund. Some of you have a fund or maybe have some high-level questions. Be sure to drop those in the chat, guys, right now during, not all the way till the end. So we have to go through like 30 or 40 of them. So just drop them in as they come along. We'll take note of it and make some time at the end for it. But I know we have a lot to cover. Thank you guys so much for being here, Alice and James. I'm excited to dive in. The floor is yours. If you all need anything at all, feel free to chime me. And again, use the chat, y'all. Use the chat.
Okay, thank you, Frank. Nice to see you. Nice to see you, everyone. Thank you, Matt, and the family team for inviting us. We're very happy to come here and speak to the family about private equity. This is what we do. This is what we love. And, we're happy to be here today. So there's a lot that we're going to cover. So we're just going to dive right in. So what are we going to cover today? Of course, I'm going to introduce myself. James is going to introduce himself. I taught a mini class in May on fund formation, and I'm going to do a quick recap of that. So that's things like definition, what's a private equity fund? How is that different than a venture capital fund? What's a GP, a general partner? What's a LP, limited partner? What's a waterfall? What are some of the exemptions that we need to be mindful of? What are the legal documents involved in setting up a private equity fund? And then James, the private equity guru, he's going to be teaching a component on private equity finance. So this is hard finance, from Bay Street, from Wall Street. So he's going to go over investment terms, things like how is IRR different than AAR? How is that different than equity multiple? So we're going to deep dive into that. We're going to go through a pro forma. So he's going to teach that. We're going to talk about our due diligence process, what's the gold standard, and some of the trends that we're seeing in United States real estate, right? So what are the trends that we're seeing in 2025 and beyond in this macroeconomic environment? We're going to talk about how we select our operating partners, and then we're going to leave a lot of time for Q&A. I know that a lot of you have a lot of questions about private equity. We're here to help and here to chat with you. So let me start by introducing myself. So who am I? I am Alice Chen. I'm a Canadian lawyer by background. So I practice in mergers and acquisitions, securities offerings. So this is like some 18 years ago now, hard to believe. So because I'm from Vancouver, BC, even though now I'm based in California, in the San Francisco Bay Area, coming from Vancouver, I worked on deals like the Lululemon IPO, forestry deals, mining deals. So very, very great training. But 3 years into my legal practice, I knew I was very entrepreneurial. I wanted to do business. So I left and started my first business, which was an international trade. And 3 years into my pivot from being a lawyer, I was named a top 40 under 40 by Business in Vancouver. So since then, since 2013, I have founded a series of different companies, and I have 3 exits under my belt. One to PwC, which is PricewaterhouseCoopers. Got involved with the family office realm. I am a co-founder in a family office fintech software, which was named by Forbes magazine last year as a top family office fintech software. So I have also a lot of experience in fundraising. So I've raised funds for private equity funds as a capital raiser, as a sponsor, and have raised money from the venture capital ecosystem as a startup founder as well. So we're going to talk about the differences and nuances. I'm a big fan of private equity because I don't like dealing with tenants, toilets, hammers, So I exclusively make money from paperwork and picking the right investment opportunities, which is why I love private equity. And I love working in this area because it gives me a front row seat on what's going on in the space and what are the best deals that are available out there. So, 10 years ago, I had a game-changing event. I met my mentor, James, and he's the one that opened the door to lead me into this path of private equity. So I'm very honored to be partner with him in this new venture, Pender Hastings Capital, as we build out a real estate private equity firm. So I'm going to pass the mic to James so that he can introduce himself.
Thank you, Alice. Yeah, it's a pleasure to be here today. Way back, I was an accountant. I know there's lots of accounting talk this morning. So I was a CPA for 24 years. And in public practice, which is where we're preparing financial statements for businesses, tax advisory. When you're a student, you want to be a partner because there's not many partners. But I eventually rose up the ranks and became a partner. And I thought I was all set. And then I realized I was really limited. So I was a business owner. I had 16 other partners, but I really couldn't get to where I wanted to be. And what I was noticing is that a lot of my clients, I had clients that did really poorly, and then some that did incredibly well. And the ones that did incredibly well did a great job leveraging capital. So they're leveraging bank debt, and they're leveraging equity, and they're leveraging, depending on their industry, acquisitions. So I decided to leave public practice and start buying companies. And I did that as a private equity group. Now, when we talk private, when we talk private equity, it can be anything. I was buying initially lower middle market companies. These were companies that had 20 to 60 million in revenue. We're buying them in Canada, US, and then Europe. But you could buy any type of real estate in private equity. There's music royalty funds. Pretty much anything that goes up in value or creates cash flow can be private equity. So to begin with, I didn't know anything about private equity. I had a little bit of exposure to it. So most of what I learned, I did by doing. So the first company I built, I took it from nothing to 800 million. That was all through acquisitions. It's a lot easier to build through acquisitions than organically. So imagine just buying 40, 50 million of revenue every time you do an acquisition. But to do that, I had to raise a lot of money. I ended up raising over 700 million over the 5 years, and I didn't know how to raise money. Many of you are much better salespeople than I am, but what I have is the tax and the finance and the accounting knowledge. So at the upper levels of dealing with a pension fund or a big family office, I can talk numbers. And so that's where I was able to raise money from pension funds. In the US, I raised money from RIAs, registered investment advisors, as well as through broker dealers. So there's lots to talk about another time about all the different sources of capital, but there's lots out there. But ultimately, what I got really good at was finding good market opportunity and building teams. It's all about people. And why did I ultimately want to get into private equity? It's to leverage. If you're just leveraging yourself, you're limited. And I found through private equity, by leveraging other people's talents, as well as investor equity, and then the bank debt, I could build a much larger company. And that's what we've done. So I now run in Canada a private equity group where we're developing multifamily, different types. And in year one, we have a run rate now of 120 million of revenue, and the target to hit 300 million in 2 years. And we've been able to do that through private equity funds. In the United States, we're focused on land development. So we're just setting up a U.S. land development fund. I could do a whole nother session on how to build competitive advantage and barriers, but what we like about land development is the national home builders only work with 2 to 4 groups. So you can't have 10. So for instance, I spent 2022 going back and forth to Dallas looking at apartment buildings. Well, there was 100,000 syndicators trying to raise money for apartment buildings. No barrier really. Whereas with land development, huge barriers, and because of that, margins are more consistent, and you don't have all that crazy volatility that we've seen the last few years, whether it was office buildings or in multifamily. So our approach is we look for niche opportunities with strong operators, and we're looking in every city. So I'm heading down to San Diego in a little while. I have discussions currently with groups out of Seattle and Los Angeles. So ultimately, we're just looking for opportunities where we can be consistent, where we can earn a good return year after year, where a market doesn't get swamped with supply, which is what we've seen the last couple of years, say with multifamily, and to a lesser degree with self-storage.
Okay, thank you, James. So why don't we get started into the core substance of this masterclass, and then we'll talk more about the trends that we're seeing and what we're focused on and why. Okay, so let me start by showing you this pie chart. So this is the asset allocation report by members of an organization called Tiger 21. So Tiger 21 basically is another mastermind that's focused on investments. And all the members need to have a liquid investable asset base of 20 million. And then they get together every month to discuss their individual portfolio allocation. So this is the average of, I guess the, tallied results of what the members are investing. I have an updated one. This is from 2023, but, the current year looks pretty much the same. So no surprise, the biggest, a big chunk of the members' allocation is real estate. So this is the red that you're seeing, that's 27%. So more than real estate, though, is private equity. This is 29%. And then the blue is public equities, with the orange being, cash equivalents, red being fixed income. So this is no surprise. So that's interesting, right? So private equity being 29%. And of course, what we're working on is real estate private equity. So it straddles both. So what is private equity? What's so interesting about it? So private equity is a type of alternative investment in which the investors purchase shares in privately held businesses. So this is opposite of a public equity company, right? Or public company that you can buy their shares kind of freely in the open market. So private equity is defined as such, and that's all it means. So it's different than venture capital. So venture capital applies more to technology or CPG, consumer packaging goods, and that is a totally entirely different universe. If you're interested in that, I'm happy to have an offline conversation about that as a founder that's raised money from the VC world. But that's totally different than private equity. So private equity is very pervasive. It's actually traditionally it's gadget factories that produce very high quality earnings, right? So these would be the companies that James used to buy. So I don't know, it could be a turbine manufacturing company, it could be a company that produces billboards, things like that. A lot of the brands, a lot of the stores that are in our lives, right? So stores like Staples, stores like fast food chains, fast fashion, Zara, Mango, these type of stores, all of them, virtually almost everything that we see and touch and use and buy are owned by private equity. So it's very pervasive. And recently, in the recent years, private equity has actually really favored coaching businesses, mastermind businesses, because of the subscription model, right? So, monthly recurring revenue, they really like growth potential. So that's private equity. But real estate is actually a really major subset. So let's look at what's real estate private equity. So real estate private equity firms raise capital from outside investors. These are the LPs, limited partners. And then, real estate private equity firms like ours, Pender Hastings Capital, we use this capital to either acquire or develop properties, right? And then we operate and improve upon them, and then we sell or rent them to realize a return on the investment. So that's real estate private equity. This diagram that you're seeing is a basic structure of who does what in a private equity fund. So typically you have the GPs, So this is general partner. These are basically people that do the work, right? They're putting the deals together, dealing with operations, trying to get, working on getting a return for the investor group. And then you have the limited partners. These are the investors. So people that write checks, right? So together we form a private equity fund, which is typically a limited partnership. There could be other permutations, could be LLC, could be, depending on the group's tax situation, could be structured a little bit more fancy, but this is the base, right? So in the private equity fund, then with the funding, then, then we go and make different investments. So this is the typical structure. And then just a little bit more about the LP and GP comparison. Again, LPs actually write the checks, and then GPs actually, do the work and operate, right? Or select the investments. Okay, so who invests in private equity? Well, it could be, retail investors, could be accredited investors. I'm going to be talking about the exemption in a bit. It could be high net worth individuals, could be family offices. And of course, there are institutional investors like the pension funds, endowment funds, insurance companies. There could be feeder funds, fund of funds. So a wide variety of different parties are suited for investing in private equity. And on the right-hand side here, you'll see that these are the top US real estate private equity firms, right? So names that you're very familiar with: Blackstone, Brookfield, Starwood, Carlyle, KKR. So sometimes, in this space, a lot of times that the people find it, okay, kind of, mysterious, or they find it difficult. Just really, it's a terminology issue. But once you kind of get to know these terminologies, things become very clear. So sometimes you hear this phrase, distribution waterfall, right? So what is that? That just means like the order in which people get paid when the investment exits. So typically, so for example, our U.S. Land Development Fund is a two-year fund, right? So at the end of the 2 years, then typically this is the distribution, right? So we, first of all, return the investor's capital. So this is a return capital. So that's, of course, gets taken care of first. And then investors typically will get something called preferred return. So they would get this preferred return before anybody else, before the GPs will get a cent, right? So this is a preferred return. Sometimes you'll see that in some of the structures, there's something called a catch-up tranche. So this is where once the LPs get their preferred returns, the GPs might say, okay, then we will be getting a certain percentage from there. But this sometimes isn't there. And then we have the carried interest, which is the remaining profit from the project that's exited. And typically you'll see things like, oh, it's an 80-20 split, or it's a 50-50 split. So this is basically a fancy word for saying what is the profit share amongst the GPs and the LPs. Okay, so again, the general partners, the people that are doing the work and putting the deals together, they earn what's called a carried interest, and they would also be earning something called management fees. Okay, so I mentioned about exemptions. So earlier I said that a variety of people can invest in private equity, right? So there are primarily two types of exemptions that you should be mindful of. So there's the 506C. This is a accredited investor exemption. And most funds will be, or most syndicators would be relying on this exemption. And these are the definitions of what qualifies an accredited investor, right? So it's someone that earns $200,000 per year the previous 2 years, or $300,000 per year as a household, right, in the previous 2 years. Or, it's an organization or someone that has a financial net worth of $1 million, right, not including their primary residence, or it could be an entity that is 5 million and above, right? And sometimes for retail investors, they're not quite qualified, then they could fall under another exemption, which is the Reg D 506B. So that's a friends and family exemption. And I know, syndicators that exclusively raise from their friends and family. So then in that case, their friends and family that invest with them don't need to qualify under this accredited investor exemption. So typically, we need to get something called accredited investor letter in order for them to come into the fund. So this is just, some nuances and points to keep in mind. Okay, so I'm just going to quickly go through the legal documents that are required for setting up a fund, and then we'll pass on the mic to James to talk about real estate private equity finance. So these are the four major legal documents that you need, right? So you need to have an operating agreement. So this is an agreement that explains responsibilities of the general partner and the investor. So you need something called PPM. This is a private placement memorandum. So this is the overview of the investment and disclosure of risk. And of course, you need to have subscription agreement. And this is, the investors agreeing to the LP terms, and it's a compliance documents for securities law. And you have offering memorandum or the investor deck, right? So this explains the opportunity, the market, the returns, and management teams. So this is the set of legal documents that you need for any type of private equity fund formation. Okay, so James, pass the mic to you, and we'll start with the investment.
Thank you, very good. Whenever you look at a offering memorandum from a private equity group or a syndicator, it's all the same thing. You'll see a few terms. So the first term you'll see is equity multiple, and really that's fairly straightforward. If an investor puts in $100,000 and the offering, the OM is saying an EM of 2 or 2x, that's really double your money. So the equity multiple is just how many times your initial investment you're going to get at the end of the term. So if it's a 5-year investment, you put 100,000 in and it's an EM of 2, you would expect to make 100,000 of profit on your initial 100,000. Return on equity, similar to the equity multiple, but in a percentage. So if you see, say, 100% return on your money, you put 100,000 in, you'd expect to get 100,000 of profit over the term. The annual return is effectively the return on equity divided by the number of years, the duration. So on a 5-year investment, if you made 100% return, divide that by 5, and you get 20. So an annual return of 20. The difference between annual return and what we call IRR, internal rate of return, is time value of money. If you give me, say, $100 5 years from now, it's not worth as much as $100 today. And it's just because of inflation. I remember as a kid, I could buy, I think, a can of Coke for 15 cents. Well, now that can of Coke is a lot more. And that's just time value of money. So a 20% annual return equates to a 17% internal rate of return. And there's an Excel formula you use that calculates it for you. The other term you might hear is a K1. You're likely all familiar with that, but the K1 is the IRS tax slip that has to go on your personal tax return, and it's showing your income or gains earned from an investment. Performa, this is super simplistic. A lot of performas you see it'll come from an Excel with 12 tabs, and it's quite complex. But this would be an example of one of the little developments that we do up here in Vancouver. I have a partnership called Lightwell, and we build infill housing in Vancouver. Vancouver real estate is very expensive, so many families can't afford to buy a house, so we're building small townhomes. So a project for us is about 10 million in sales after, by year 3. It's usually a 2-year hold. So we're showing here cost of 8 million, the profit's 2 million, and then we have a split between the GP and the LP. So fundamentally, that's really what the performer is showing. Most performers are much more, there's many more assumptions and line items, but ultimately it's showing the investment thesis and the assumptions made for either the investment in real estate, if it's income, or if it's development.
Okay, great.
So ultimately, what do investors look for? There's at any one time there's tens of thousands of people raising money, and I see newer sponsors and private equity groups make the same mistakes, which is they're just selling a return, and you can get return anywhere. I was really struck. I was at the Tampa event that you all put on, and I was really struck by how entrepreneurial everyone is, and very sales and marketing focused, which is great to see. But ultimately, buyers of anything are buying because of emotion, and numbers aren't all that emotional. So ultimately, it's management team track record. You're really selling yourself and the team. When I first went into private equity buying companies, I didn't have any experience in doing it. So if I had gone to investors just by myself, I wouldn't have been very successful. Because they'll say, James, show me your track record. And I'd say, well, I have none. I've been just advising. So I went out and found a partner who had experience operating businesses. And so the two of us together, me on the finance side, and then his name was Kerry, with all the operational, he was an engineer as well, experience, we were able to raise the capital. In the case of real estate's new for me as a private equity fund, but I'm not selling myself. So here in Vancouver, I put a team together. My partner, Randy, has 18 years of construction and has been developing for 8 years. So when it comes down to track record and years of experience, I'm showing, his track record. I have a 25 plus year track record in business, buying and building companies. So even though, real estate's new, people can see the deep experience. I'm part of some passive investing groups in the U.S. where these are the LPs, and many of them haven't done well lately. During a lot of them invested in multifamily, and with interest rates going up, returns fell. But a lot of them are saying they won't invest with anyone with less than 10 years experience. I'd say you want people with a lot of business experience. Does it have to be 10 years in that sector? No. And I'm proof of that. I'm on to fund 6 already since April up here. And it's just because I know how to run private equity funds, but I wouldn't be able to do this except because of Randy and my other partners. The other thing is the investment hyped or do you disclose the risks? What I find, especially in the U.S., it can tend to be very promotional, where all the risks are avoided. But the people with all the money and who are more sophisticated, like high net worth and ultra high net worth, they know there's risk, and so we always start with risks, and that builds a lot of credibility because there is no investment that doesn't contain risk. Even the stock market, it doesn't go up every year. So really focusing on risk is very helpful, builds trust. And then, are the assumptions reasonable? I was looking at even as late as I think it was mid 2023, where some multifamily syndicators were trying to raise money, and they had 6% rent growth a year when it stabilizes completely out to lunch. So if they're too bullish, it's going to be a red flag to investors, and they won't invest. And does the investment fit with the general market sentiment and LP goals? I was speaking with a partner in accounting firm the other day, and their clients who are focused on risk. This would be venture capital, cannabis companies. There's just no money. There's no interest in the market for that. Real estate, huge interest in real estate right now. Even with all the the carnage in office and multifamily, people understand why. And but with rates coming down here in Canada, rates are coming down fast. Our economy isn't as strong as the U.S. So it's dropped 125 basis points the last 4 months, and will probably drop another 100. But that's what people are looking for in the States as well, is continued fall in interest rates. And then does it fit with the LP goals? There's no point trying to sell a high growth opportunity to someone who just wants income, as an example. So you have to know your market. So for instance, low risk tolerant investors should avoid higher risk. I focus on high growth, high return, short duration investments. So I'm looking for 30% return per year. Part of the reason is that that's who I am. Like I just believe I can spend my time producing high return or low return, and rather produce high return. The other thing too is it doesn't take long before you're competing head to head with Blackstone. My last company, I'd fly to New York every 6 weeks, and I'd meet with family offices. And that was a small company compared to Blackstone. Blackstone has 1.2 trillion of assets under management. But even so, it won't take long before I'll be presenting what we're doing to investors, and they're going to compare us to Blackstone. And so for me to compare well, I have to have higher returns and be more niche than Blackstone. And that's why we focused on these niche segments. So we do differentiate. Blackstone can produce 8 to maybe 15% returns, sometimes higher, but it's usually lower returns because they're focused on so much capital. They have to make big macro bets. Whereas with us, we can be niche and more nimble and get higher returns. So what do investors look for? Investment duration. My last company in private equity, the downside to that is it takes a long time to build earnings. So if earnings are, let's say I buy a company that was doing 5 million of profit, 5 million of EBITDA, and might have 200 employees. Well, for me to grow that, I have to add a lot of employees. You have to add more systems. It's complicated. And meanwhile, you're reliant on global macro forces. Look at what's happening. World politics is really just competition, isn't it? U.S. is competing now more and more with China and other countries, and so you're going to get interruptions to supply chains and other stresses. So for me, a good way to manage that risk is shorter term investment. So everything we're doing, we're looking for under 2 years because it allows investors to manage risk. And what we've just seen is the longer the duration, the more that can go wrong. Look at the office space. Office investing was always seen as a no-brainer. Well, now it's not because just social change. We also look at tax treatment. We sell, when we're marketing, we really market tax solutions. It's one thing to help people make a good return, but the other side of that is how do we lower the cost? And what's the cost? Well, the biggest cost is taxes. So we use corporate structures here in Canada. We're looking to do the same in the U.S. so we protect more of the gain or the income. The less tax you pay, the more money you can reinvest and compound. It's all about compounding. The other thing is competition. The one thing I didn't like about, as I mentioned before, with say the value-add multifamily space is it's too easy. And probably I know many of you are in home flipping and short selling. There's a whole range, and they're all good businesses. But the lower the barrier, the harder it is. So we look for investment areas that have barriers. And we're also looking at demand, so geographic location, number of operators in each area, number of clients. So this is where, with land development, what we like about this is it's niche, returns are high. Our customers are the big national home builders. They have big balance sheets, but they only work with a few groups in every region. So whenever I'm looking at an investment opportunity, and if any of you are interested in building your own private equity fund, this is the thinking you'd have to do, which is you're looking at kind of macro first. So just using land development as an example, what we look at here is population distribution. Where is the demand? If you look at population pyramids in the United States, we have a population of 340 million people. 80 million are millennials. I think the baby boomers, which used to have 80 million, they're slowly dying. They're about 70 million. My generation, Gen X, is around 65. And then Gen Z would be about 65 million too. So ultimately, we're looking at what is happening in the economy because of demographics. And what we're seeing in housing, just using housing as an example, is boomers aren't leaving. The whole idea before is, well, as they get older, they're 60 to 78 years old, 80 years old. They prefer to age in place because they want to avoid the senior homes. So as a result, there's not enough housing because people are always thinking they'd sell, and if they don't sell, then where's the housing for that? Meanwhile, you have a lot of pent up demand from millennials and Gen Z. Millennial homeownership right now is around 60% from what I've read. Gen X and boomers are at 80. So you just think 20% want to buy homes. So on 80 million people, that's 16 million people that want to buy homes. And then of course, Gen Z, who are say 13 to 28. Well, a lot of them still are living with families, but there's another 65 million people that will want to buy homes. The other variables we looked at is just how many homes are needed. I think the typical stats you read are understated. I think the actual demand for homes is much higher than 4 or 5 million. And right now, just given where interest rates have been, people are I don't want to use the word stuck, but they probably feel stuck because they don't want to trade a 3% mortgage for a 6.5% mortgage. So for us on land development, there's lots of demand there, and it's short investment duration, 18 to 24 months. And the big land, the big national home builders, this would be Lennar, D.R. Horton, they don't want to own land. Land, impacts their financials, so they want to outsource that to other groups, and those are the groups we're investing in. And also relatively small capital requirements. So this is what we like, whether it's land development. I'm also looking at on the West Coast, infill housing, and it's the same characteristic. So ultimately, your success in private equity is all about people. My very first investment I made was a steam turbine maintenance company. I didn't know anything about steam turbines, but it's what's used in power plants. So you have a heat source like natural gas or used to be coal, and you heat up water in a big boiler, and it produces steam, which turns the turbine, which feeds into a generator, and voila, we have electricity. So that my very first investment was a home run. Just wish the numbers were bigger, but I made 40 times my money in 9 years, and it was because of the people, and I didn't know it at the time. So I just got lucky. A lot of people in private equity think they're smart by doing well, but often this is just luck. So I got really lucky with great people, and I made that first investment in 2010. Well, in 2012, I thought I would try my hand at investing in commercial mechanical. So I was an industrial mechanical with the power plant maintenance company. So I bought into a plumbing HVAC business, and it was horrible. It was the worst experience I've had in my life. Just terrible management. We won too many contracts. We couldn't manage them properly. I lost so much money. It's just nauseating. And so I just wound that company down. And after that happened, I was asking myself, what happened? And ultimately, it was my failure in understanding how people worked. Because whether it's in a BCom program at a university or even me as an accountant, we're taught a lot about financial analysis, ratio analysis. We can build pro formas, we can read financials, and even on the operating due diligence, it's pretty straightforward. But ultimately, our success in business, no matter what it is based on the people around you. And no one teaches that. Like I did notice at the last family event, there was someone presenting predictive index. Well, that was one of the tools we used. We also used Berkman, and then predictive index has an aptitude test. So we got really good. So I became a psychometric analyst myself to understand people, because you need a scientific way. And so this is what we've done here with operator selection. We look for people that have the right traits. So this is where Shane Carter, as part of family, fits with who we're looking for.
James, do you want to talk a little bit more about the project lineup from Shane, and then we can talk about some of the other operators that we've been looking at?
Sure, absolutely. So with this is Shane's pipeline. Not, maybe not all of these will come to pass, but the bulk will. And what we like about these is the equity required as well. They're not massive checks. Like we don't need to get 20 million at a time. Averages out to about $2.5 million. And really, this business is it's pretty straightforward, which is we're buying land from a national home builder like a D.R. Horton or Lennar, and we're putting in all the services. So this is where Shane oversees that side, which is water, sewer, lighting, roads, driveways. It takes about 2 years, and you can see with the number of lots how many lots are created, and then it's sold back at a predetermined price back to the national home builder. So pretty straightforward. And that's what I like about it. Simple, but also the barriers there, because a large national home builder is not going to work with just anyone. They don't work with many groups. It's typically anywhere from 2 to 4.
Great. And let's talk about the land entitlement process as well that comes before the land servicing.
Sure. So with if you think of land, so the first thing I should mention is just generally with housing, and many of you probably already know this, but after the Great Recession in 2008, there wasn't a lot of home building happening. It was much reduced between 2009 and even all the way up to probably 17. So we don't have enough houses, but it depends where it's geographic. And so the large home builders had been devastated because it was really a housing crisis back in 2008. So they weren't investing in land either. So so the housing groups need land, and there's not enough of it. And when I say not enough entitled land. So it starts with a company tying up the land. Typically, you don't buy land up front because it's too risky. So it would be tied up for, say, 1 to 2 years with the landowner, and then it's up to the land entitlement company to get it zoned and permitted. And once they've done that, then they can sell that to a national home builder. And we've seen different business models with different land entitlement companies. The model we like the best is where the land is tied up, and then they find the buyer in advance before they spend any money. They have a contract with the national home builder to buy the land, and then they close on the land at the same time they get paid by the home builder or the national home builder. So it really reduces risk in any business about managing risk. So in terms of what we're doing with PHC Land Development Fund, we're starting with 10 million. That'd be 4 projects, and then we'd have Fund 2, Fund 3. It's the same thing I've done up here in Vancouver. To mention, we're at Fund 6 now. So in the last 6 months, it's about $4 million of fund up here. So we've raised quite a bit of money in a short amount of time. And it's the same idea with land. So the equity multiples typically annual return target of 26 to 32% per year. So depending on the time duration, it's anywhere from 1.5 to 1.6 times in 2 years. We also do have a co-GP program where other capital raisers who want to partner with us can become GPs. And we're partnering with the operating partners who are the experts, because getting back to people, it's all about their knowledge. We don't want to try to take something on or invest in an area we don't know anything about. So in this case, Shane's a good example. He's been doing it for 25 years. So he has lots of expertise.
Yeah, and as we grow, we are also looking for people that are interested in this path of private equity. And if you're interested in that, we welcome a discussion about that as well. So yeah, so this is the QR code of my contact information. You can take a picture. It will take you to my cell number, my contact info. Of course, we're in the Black Book as well. So yeah, we're, really happy to have given this masterclass, and now we can open the floor up for Q&A.